Hello and welcome to this special live coverage of the US non-farm payrolls. The data is going to be out in 7 minutes, which gives us about 7 minutes time to prepare the charts and take a look at what's going on with the markets. What we will be doing is providing you guys with live technical analysis and as well my live interpretation of the data when it comes out. You just need to understand the following is that trading the non-farm payrolls unfortunately is extremely risky, and the markets could be very volatile, and things could potentially rise strongly because good numbers, and then for some unknown reason people sell and it goes to the downside. So it's a bit of a gamble, but people like to trade it, and I have traded myself many times, and sometimes you get some good opportunities. So be fully aware of that and click here on risk disclosure if you have any questions about this. It's good to see so many of you guys here. I have Elia, I have Juan, and I know as well we have Dwight Kelly on Twitter as well. So it's good to see you guys here, and thanks for joining me. Let's get going. So let's take a look, and we have Hi here as well. So good to see so many of you guys here. Awesome. So this is just a screenshot from a Bloomberg platform, and this is the actual and the surveyed outcome. So what we're looking for here is the following. For the US, we're looking for the actual non-farm payrolls to print 185,000. And then we're looking for wage growth. Let's see if I can find it here. So many, here we go, hourly earnings in the US, 2.7. This is really the important number that we need to beat. If it's 2.8, 2.9, I would guess that the dollar is going to gain. On the other hand, if it's lower than this, maybe 2.5, then that would be the dollar would be selling off on the back of that. This is also important, but it's less important. It becomes more important, of course, if the number is 225 or above, or if it's below 150 as well, then that's going to be viewed as a problem. But in general, this is really what's important. And then in the US as well, you have the unemployment rate, but it doesn't change too much. So this is sort of the key thing you're looking for. So again, if the numbers are higher or better than expected, most likely the Fed is going to go ahead and raise interest rates, which, as I said, is going to do 3 times. And people, if we have very good numbers, people might say, well, we might increase interest rates 4 times, and that way the dollar would gain. Now, what I would be looking for, I think what makes perfect sense in the case of, and let me just load the charts. So I think the dollar CAD, so the Australian dollar, is an interesting market to focus on. Why? Because the market is trading sideways within this narrow range, and the overall trend is bearish. All right, and bearish just means that the whole thing is going down lower, and it's going down lower on its own accord. It doesn't have to. It could easily continue to go down lower independently of today's outcome. But obviously, if the outcome, the US numbers, are very strong, then I would argue that you will probably see an acceleration of this downtrend. So I think what you want to focus on here is 76.38. Take that level out, and then we could have an acceleration of this decline. At the same time, if we take out 77.28, which is yesterday's high, this market could potentially start to bottom out. The problem with it, though, is that you can see here that this market, because it's been going to the downside, it will take out the high, but a lot of people that are just trading the trend and following the momentum, they're looking at this and they're gonna say, all right, the overall market is actually going lower, so even if it breaks the upside, doesn't mean that it's going to rally a lot, and that's an issue. So the next step we need to do now is try to identify a market that could gain on or where the dollar could lose out on bad numbers. And I think one of the better markets, or the one I like the most right now, is the price of the pound. Why? Well, the logic again is the same. We're dealing with an uptrend. Overall, the market is heading to the upside. However, in the very short term, this this high here is stopping price. Okay, so with this in mind, if we take out this level, maybe this little short-term downtrend would be over, and instead this overall bullish trend would take over, because you're dealing with that low. You have a low here like this, and then you have another low here. So this could be a sort of a pair to work with if the numbers are bad in the US. So if the US numbers are not good, then this could potentially be interesting, as the market could gain to the upside in the following fashion. And these are the two markets I think we're focusing on. You do have as well the New Zealand dollar. If we take out this high, the market could potentially trade like that. But let's focus right now on the Aussie dollar, and let's focus on the pound dollar. The data is going to be out in about 20 seconds time. Again, Aussie dollar indicates the data from the US is good, and pound dollar indicates the data is bad. So the data is out now. Bad numbers, the non-farm payrolls are not good. Now let's take a look at wage growth. Wage growth meets expectations. Okay, let me show you what I mean. So the actual non-farm payrolls, they printed 100 and so much data here, 103. All right, this is not too good. Then you have the unemployment rate ticked up a bit. Not a huge difference, like 4.1%. No one really cares about that. But this is not too good. But then you have wage growth, which is a good solid 2.7. So I would argue that maybe the decline here, the change in non-farm payrolls, could potentially be a bit of a statistical fluke. I don't necessarily think here that is sort of a major. I mean, it's lower than expected, definitely, but it's not like very bad either. Apparently, this is the sort of the lowest amount of jobs added in the last 6 months. So the lowest amount of jobs added in the last 6 months. I think at the end of the day, I think what is important here to understand is that the data here is slightly, well, it's not that good, right? Let's take a look, and that, what would that mean? It would probably lead again, maybe that the pound dollar is going to have easier time to bottom out here and potentially head to the upside, and just continue to trade, because again the pound dollar overall is creating higher and higher lows, so this could easily help it a bit to actually look to bottom out. And then sort of other pairs, like this is not rallying at all, if nothing, just because again it's a sort of a downtrend already. Let's take a look at the New Zealand dollar. New Zealand dollar also pretty much not changed. We could again maybe move up, but I don't think we're gonna trade. I mean, there's very low, if any, reaction to the market on the back of these news. The euro is still, at the lows. Euro overall, has sideways sort of bias, trading sideways like here, and could potentially just bottom out here. But I'm not buying that one. Let's see what gold is up to. Gold is not to change either. Let's see. I didn't check on it, but let me take a look at the Canadian data. And as well, if you have any questions, just put them in the chat box and I'll see if I can answer them. So in Canada, the numbers here were slightly better. Let's highlight this with blue. That's Canadian data. Canadian unemployment rate, see if I can find that. Unchanged, or as expected, at 5.8. There is slightly softer wage growth in Canada. Hourly earnings permanent employees year on year. Let's see if there is other data from Canada linked to the employment. Yeah, I think this is it. So yeah, Canadian data is good or bad? I think it's it's like on point, really. Slightly better here. Net change. Maybe the Canadian dollar is gonna have a little bit of a boost. Let's see how it's reacting. It's trying to trade slightly lower. Okay, let's see if you have any questions. Hey Dwight, good to hear from you as well. I hope you've been well. So Ricky saying, what was the expectation? So the expectations for the market, for the non-farm payrolls again, was that the outcome should have been 185, but the actual outcome was 103 according to this Bloomberg estimate. And then you have the actual unemployment rate, which was slightly higher than expected, which is not good. But you have wage growth, which was pretty much at 2.7, which is in line with market expectations. So I think the data, the US data, is slightly weaker. And then, as I said before, I think this could potentially help markets that were already bullish to potentially continue to move to the upside. The US doesn't have to fall, because like I would need to spend more time investigating. I don't know exactly why the numbers, printed 100,000 instead of 185. The thing with this though is that the change in from payrolls, there's a lot of, it's just a sample. So they don't actually check, exactly how many jobs were created in the US. They have some sort of a system where they maybe, I don't remember exactly the process here. I know the process for the unemployment rate. The process for the unemployment rate, they call people directly and just ask them, are you employed or not employed, or you're looking for jobs, and so on. The non-farm payrolls, they get these numbers from corporations. Now, obviously, they can't check corporations across the whole of the United States. So they just grab a larger amount set so it can be representative for what's going on within the whole country. But this set, I don't think is big enough, because with the actual headline number, you will many times see some crazy moves. Last time it was 326, but the expectations was about 200 or something like that. So again, like 100k overshoot, and then this time it's like 100k undershoot. So I wouldn't trust this number too much. I think at the end of the day, you look at these numbers, unemployment rate pretty much at good levels, 4% is really good, and then you have wage growth at really good levels as well. So most likely, people gonna treat this as a good market. And the only sort of way of profiting on, or probably the way to profit on this, is to try to work with markets where the trends were already bullish. So in the euro, there's no real trend here to talk about. In the pound, the market should really bottom out here and head to the upside. We're just limited by this downtrend. The yen, you know, might move back a little bit, but again, it's a solid number here, so I wouldn't be selling. I wouldn't be selling the dollar yen here while betting on this to move to the downside. Let me see here. I had some questions. How do I expect the S&P to react on the data? So the number one problem with the non-farm or with the S&P is that the market anticipates rate hikes, and these rate hikes is stressing companies because higher interest rates just makes it more difficult for these companies to borrow money. Now there is something called the Financial Conditions Index, and let me see if I can load that. Let me see here, just give me a sec. So the Financial Conditions Index is an index that just tells us the situation, let us know if things are good or bad. And let me just save this chart. How many of you guys heard about the ISM indicator? The ISM indicator is just indicator. It's like a survey, and it helps us to know if, you know, it's sort of an indicator of economic growth. That's what it is. Now, if you just give me a second, because I'm preparing a chart here. Okay, so this is what I did here. You have the ISM, which is the green line, and the ISM, when it goes to the upside, economic growth, high economic growth. When it goes lower, below 50, it means that the economy is contracting. Now this ISM line is the combination of ISM manufacturing and ISM non-manufacturing. You can see here, this is the 2008 and 2009 recession, how the ISM index, which was very strong at 50.9, declined and, you know, went below 50, and then in 2008, you know, we had this recession. Now, the other thing I'm watching here is the white line, and the white line is the Goldman Sachs Financial Conditions Index. It's an index made up of things like stock markets, interest rates, and the currency. And I inverted it to show you, so I can show the correlation between the ISM and that indicator. And you can just look at the ISM to begin with. The ISM itself is at the very high, okay? So it just tells us that the US economy is very, very good and very, very strong, and that is why people are buying stocks. But obviously the best time to buy stocks was in 2009. Why? Because in the fallout of the stock market declined 40-50%, something like that. So then you could buy them very, very cheap, and since then they have gained massively. And they gained because the economy recuperated. So what the ISM is telling us right now is that the stock market, or that the economy is doing really, really well. And most likely, as long as the economy is doing well, the stock markets will continue to head to the upside. But what it also tells us, this indicator, is that maybe this is it. Maybe the economy is not going to improve much more. Actually, this indicator can't help us with that, but because you can see that the ISM has been at the highs for a very long time. uh, there are other indicators called the GDP gap, and the fact that the unemployment rate is so low. Think about it from that perspective. The unemployment rate is at 4%. How likely is it that the unemployment rate is going to go to zero? Very, very low. It's been lower, I think at 3% or something like that in the 1970s, I think it was, during the Korea War. So during the Korea War, the US mobilized, and everybody was, not everybody, but there was a lot of people working because of the war. So that's how they got the unemployment rate to those levels. So from that perspective, if you think about it, the unemployment rate can only go worse. It's been, I think, 8, 10, 12%. So the economy can't only sort of, they can't really improve too much from these levels. And most likely in the future, the Fed is going to increase interest rates. And because of that, because there's limited growth potential in the economy, there's also limited growth potential in the stock markets. So from that perspective, at least for now though, if you look at the white line, it still has a bullish trend. If you look at the ISM, it still has a bullish trend. Obviously, stock markets move a little bit ahead, so we don't know for certain if, maybe this is gonna catch up with the stock markets. So the stock markets might be moving ahead of time here. But I think in general, at least for now, it shouldn't be too alarming for stock markets. It's impossible to know exactly how we should position ourselves, but I can tell you this. If you look at the S&P 500, the S&P 500 overall is in a bullish uptrend, okay? And you have the February lows. Right now, the market is supported by the February low, all right? So the trend, as long as you trade above these levels, the market should be okay. But if you take out that February low, then most likely the market's going to go down and down. But I don't think that's going to happen. In fact, I suspect that the market bottomed out here. There is a problem, of course, with Donald Trump yesterday. He said, let's see if we can add more tariffs against China, accumulating up to $100 billion. Still not huge numbers, but I mean, it's a lot of money for everybody, for any single individual person, but for as the economy as a whole, it's not a lot of money. So I have a suspicion that we bottomed out here, even though Donald Trump has been saying what he's saying. It's the same with the Nasdaq 100. Started to stabilize. You have as well the Dow. See if I can show you the Dow. The Dow as well, was creating lower and lower highs, has stabilized. You have this indicator, which is called the CNN Fear and Greed indicator, and I've done some analysis on this, and you can see here how the indicator right now is at a rock bottom, and usually at all these lows in the past, it's been a good time to actually buy stocks. And the actual index itself, let me just see, there's some advertising going on here. The indicator itself, you look at the VIX, you look at the yield spread between junk bonds and investment grade bonds. Other sort of technical indicators like net 52-week highs versus lows. This is the average put to call ratio, which shows how people are positioned in the option markets. And then you can see here stocks versus bonds, and you have all these different indicators there, plus the moving average, and they make this index, and it's actually a very, very good index. If you are trading stock markets, check it out. It was introduced to me by a guy that managed money professionally a few years ago, and I started looking at it, and it works really nicely with the stock markets. It does provide an intro. For example, here, when the market was here earlier this year, I did actually buy the S&P 500 when it was down here actually. So I actually did 2 trades. So I bought here, and then I traded it all the way up, both profits, and then it collapsed, and then when the market moved up here, when it stopped creating these lower highs, I bought here, and then the market moved up. and book profits around these levels. And now we're back at the same levels again. So I think this market, if anything, is probably going to head to the upside. Check out this level here specifically. Definitely should highlight to us that the market has more turned bullish. We never know for certain though. So if you are interested in to trade something like this, then 25.29 is the level you want to be watching. So the ISM, by the way, the ISM is just a survey. See if we can find the questions. I only find, so I'm not gonna find it now, but it's questions that they ask people in the industry, big corporations, and they ask them, did you hire more people? Yes, no, unchanged. Did you increase the prices on your goods? Yes, no, unchanged. Delivery times, are they prolonged? Yes, no, unchanged. They ask a bunch of questions like that, and then they calculate this indicator, and with the help of that indicator, they have linked it to GDP growth. So there's a nice link between the actual ISM and GDP growth, and that's why people look at it. So I got a question here about what's my opinion on the not ongoing trade war between US and China? So obviously it's escalating a bit with the actual with the latest move by Trump yesterday, it's escalating a bit, and we need to see exactly how this is going to be resolved. But check this out. US steel imports. So this is the US steel imports in 2017. I didn't check the source, I just found this online. So in the US, they went strong, like everybody's gonna be included, right? But then, here's 16.7%, that's Canada, and they just made a deal with them. They're not included in that part. You have South Korea here, 9.7. They did made a deal with South Korea, so the US car manufacturers are now allowed to sell twice the amount of cars. And at the same time, North Korea, I think it needs to, the quota that they have dropped with about 30%. So then that's clear. And then you have Mexico, so another 9.4, they were not included either. And then you have Germany, which is here, not included. In fact, the whole of EU is not included. So in Brazil, this is another big one. So you got 16, 13, 9, 9. And then in this little section here, I think you have Netherlands and things like that. So a majority of sort of the steel imports at the end, that they're the biggest player, are not included. You cut this off, like none of these countries here are part of that deal any longer. I mean, they're not limited by those tariffs. So at the end, it's just some few selected countries that are still, like China, for example, that are still there. And the Chinese obviously retaliated. They said we're not gonna put quotas on worth from the goods from the US worth 50 billion, right? And now because of that, the US came back. Okay, so you do 50, which is actually the same that the US did the first round. Trump wants to do another 100, but the advisors of Donald Trump have in the media said that they're not interested in trade wars. They just want to negotiate, and we saw that very, very quickly here, because as the U.S. got its will through, they just extend most of the countries. So I don't think there's an actual ongoing. There's some sort of trade wars, and it's definitely spooking the markets. But there's other things as well that are driving the markets that I can show you right now. But then we need to wrap things up. So how many of you guys heard about the City Economic Surprise Index? loading it as well here. So the City Economic Surprise Index, what is that? You know this calendar that I just showed you on from Bloomberg? It's the same sort of calendar you will find here on TradeCaptain.com, and it's the same calendar you'll find, on other big websites. So you have all these consensus forecasts, and then you have the actual outcome. Now these consensus forecasts are created by analysts, economists at the big banks. So they just ask a bunch of people, like I think for the non-farm payrolls they ask maybe 98, 110 people. And they ask them, what do you think the non-farm payroll is going to be? And then everybody's going to give their estimate, and from this they're going to provide this consensus estimate. Now what is interesting is that there tends to be trends in how these estimates are aggregated, because if you say if the consensus is 193 but your own data says 50, then you're not going to go and tell Bloomberg, oh, I think 50, while everybody else thinks 193. So what you're going to do is you're going to push up your estimate. You're going to say 150, right? So what happens is that everybody sort of clusters around the consensus, because if you're too far away from the consensus, you can be punished. Like if you say 50 and the actual outcome is 150, then you can get fired from your bank or wherever you're working. At the same time, if you say 500 and everybody says 293, then again you can get fired if you continue to do this. So everybody sort of goes into the middle. And because of that, these consensus estimates change very seldom. And what is interesting is that the Citibank or Citigroup has done an index that shows if we're beating or not beating the data. So here's the 0 line. So when we're above it, we're beating, and when we're below it, we are not beating. So you can see here that US, this is for the developed economies. So from mid 2007, the data was beating and beating and beating and beating. And of course, if the numbers are stronger than expected, people want to buy stocks, right? And the economy is sign that when the economy is doing better. But then you see we reached a peak, extreme levels, and because of this, not because of this, but when it goes up, everybody raises their estimates. When we had good data, people think, well, we're probably going to have more good data. So then what happens is that suddenly the estimates are too high and the data starts to fail to meet expectations, and then things go down. And so this is what's been going on as well. This is probably a better driver than trade wars, which means that what's seen lately is that the data globally is failing to beat expectations. And because of that, I think that most likely the stock markets are weaker on the back of that. But eventually, I don't know when, maybe we need to hit these lows here, but in the next few months or something like that, again, the data should start to improve, and then we're probably going to head to the upside. So being bullish on stocks, eventually, I think it makes perfect sense. In fact, one can be bullish already today. As with all speculation, you trade several times, and a majority of the trades are probably going to be bad. In fact, we've done some analysis in the past, and I think 60% of traders win. 60% of, so you do 100 trades, 60 are winners, 40 are losers. But that's just a retail trader. I think the average professional trader is probably a little bit lower. Why is the professional trader less good than the retail trader? Well, because the professional trader, he was usually gonna look to buy, and then he's gonna look for a big move. So what they do is that they put maybe 1-2% of the money on a trade, and if it goes up, you have a big nice trend. You make risk, say 1%, you make 3% return. So they're looking for those sort of ratios. And with that in mind, again, as I said here, I suspect that maybe the stock markets did bottom out. Most likely they did. At least that's what I think. And I'm sure some people are buying around these levels. Risk a few percent. If it goes good, they make more. If they don't lose too much. Okay, so we got a question here. What does this affect the how does this actually affect the Swiss franc? So let's take a look at the Swiss franc, and then after that we're gonna wrap things up. Dollar Swissy. This is a 4-hour dollar Swiss franc. Remember, this had the nice head and shoulders, took out the high. So the head and shoulders pattern is derived in the following way. This is the head, and you copy that, put that on top, and the market should probably maybe move all the way up to the high here. So this is a target because of this inverse head and shoulders, and we're almost there. Technically the trend is still bullish. I think the level you want to focus on is this level down here, and again the data from the US was not really that bad, so this is like trading a bit like the dollar yen. So I think this might go down a little bit, maybe to 95.73, and worst case 95, but then as long as we trending higher, which we're doing now, so as long as, let me see if I can get this line working, as long as we're heading upwards like this, this market could again down and probably up, I would argue. Okay, so I got a question here. Ravi says, hey guys, I'm new in Forex. Can I ask a straightforward question that I have? Aussie dollar pair on screen. Should I put for short or long? So if you want to buy or sell, really depends on the sort of analysis you have conducted. And what I said today, let me load the right chart. What I said today is that if the numbers were bad, then if the numbers were good from the US, then maybe the Australian dollar would continue its downtrend. I do like to trade with the trend. So when prices are creating lower and lower highs, like it's doing here on the 4-hour, when we take out a low, usually we continue just to the next sort of support level. So here, potentially all the way down to 75.29, okay? But the data from the US today was not actually that bad, so people decided not to necessarily sell too much. So I think if we're gonna use the norm for payrolls, there's really no trade here right now. But if you want to go with the trend, like the general trend, if you just disregard the non-farm payrolls and you just work with the idea that we're heading lower and lower and lower, then from that perspective it makes sense to short, to sell, because when you short the Australian dollar versus the USD, that means that you're betting on dollar strength. And here I am bearish, which means that I think the price is going to continue to move to the downside as long as you trade below 77.63. And again, the way one would trade this is that you do a lot of these setups. You don't just do 1 or 2 or 3. You do a lot of them, and you do 100. And again, 50 of these is gonna be losers. 50 of these are probably gonna be our winners. And the key point is that we're trading with the trend. So when things go to our favor, like here for example, if indeed it goes lower, we could potentially make maybe 126 pip or 1.64%. On the other hand, if we lose out, we're gonna lose 75 pip or 1%. So again, you risk about 1%. If it goes down, you make 1.59. What does this mean? Is that in the long run, you multiply 50 with 1.5, and that gives you 150. So the average winning trade multiply by 50, so you win 75%, but then at the same time you're gonna lose 50. So 50 multiplied by 1, well, that's 50, right? So you're gonna have losses. You're gonna have total wins of after 100 trades, you'll be 75% up, but you will also lose 50 to get this. So your net profit after 100 trades with 1% risk will be 25% return. Obviously, if you trade with higher risk, say 2% return or 3% return, this multiplies with that. And that's how people look at it. It's like a numbers game. One single trade is not important. Rather, you look to trade as many times as possible. And from that perspective, yes, as long as trade below 77, 63, I'm bearish. And I suspect this market could continue to head to the downside. Okay guys, that concludes today's market update. We will host another webinar shortly. Every day actually, Monday to Friday here at the live training room, we talk about the markets. So just come back to this special page at 9 a.m. London time, Monday to Friday. We also have some special webinars, and we use a different channel. We use what we called GoToMeeting. And what you do here is that you just need to become a member of Trade Captain, which is free. So you just need to register. And we're going to host a special webinar on April 10th, which is a webinar where we going to look at some of my trading ideas that I've been trading this year to see some of the good ones, so you can try to detect and kind of sort of understand how I trade the markets. The other thing as well is that we're going to talk about potential future trade ideas. So what is really interesting for the next few weeks. And that's something we're going to discuss here. So you're most welcome to join. Again, it's free. You just need to become a member of tradecaptain.com. And that's it. Okay, guys, we're going to wrap things up. I hope you have a good day. I hope as well you have a good weekend. And thanks so much for joining. If you are here, just click on, if you click here, you can subscribe to us. So please subscribe. And please like the video and any comments as well. Talk soon, guys. Bye-bye. You're welcome, Ravi.